Recording in progress.
Very good evening, dear esteemed partners, valuable clients, and friends who've joined in today to take this time out to experience the Union Advantage, as we call it, the Univantage, the MP code, decoding the Monetary Policy Committee meeting that happened this morning with Parijat Agarwal, who heads our fixed income. So this is Parijat is not new, neither am I. I am Aarti Marianis. I manage sales for South for Union Mutual Fund, and Parijat is my senior colleague who heads the fixed income team at Union AMC. So without any further delay, I'm going to invite you, Pari, to take over to run us through all that was announced today, so that we get back home today with some bit of clarity on what is in it for us. Over to you, Pari.
Thank you, Aarti. And Yeah, thank you, Aarti, and uh, you know, uh, good evening to all of you. I'll explain the MPC decisions discussed today and share the PPT with you. Is this slide visible?
Yeah. Yeah, if you could just make it full screen, please.
Yeah. So now today, as expected, the MPC decided to hike the repo rate by 25 basis points. This was widely expected. So the policy repo rate stands at 6.5%. The STF rate, which is a standing deposit facility, stands 25 basis lower at 6.25%, and marginal standing facility stands at 6.75%. Now, in this decision, two external members of the MPC voted against this resolution. Four voted for. Similarly, in terms of the stance, MPC decided to remain focused on withdrawal of accommodation to ensure that inflation remains within the target going forward while supporting growth. Similarly, for the stance, four voted for this and two against the resolution. Now, the other some measures were announced. These were on regulatory and operational measures like introduction of securities lending and borrowing, draft guidelines for recovery of penal charges, and so forth. So the key here is that the policy was on stated lines. Markets were expecting 25 basis rate hike. However, on the stance, the market were divided that some market participants expected the stance to move towards neutral so that as to give a direction that MPC is moving towards a pivot, and some market players were expecting that RBI would keep the door open for further rate hike by not changing the stance of the monetary policy. However, with
Parijat,
this,
sorry.
yeah,
I think you may have to go on a full screen mode. The slides are
okay,
not visible. So if you could just click on the
just
full
hold on.
screen. Yeah, thank you.
Yeah, is this visible?
Yes,
Okay.
thank you.
So as I mentioned that the RBI has kept the door open for another 25 basis rate hike depending upon the incoming data. So that's where the view is now. Now, in terms of the growth, if you analyze the growth and inflation projections by the MPC, the MPC is very clear that the growth has been resilient, and for the full next year, financial year, the GDP is expected to grow at 6.4%, and this is in line with the economic survey which came out just before the budget, which was at 6.5%. So growth remains resilient. So the RBI and MPC is quite comfortable on terms of the growth trajectory. However, they have said that domestic demand has been sustained by strong discretionary spending. Urban demand exhibited resilience as reflected in healthy passenger vehicle sales and other high frequency numbers. And government's continued thrust on capital spending and infrastructure to support investment activity. This was very clear when in the budget, which was announced on the first. Now, non-oil, non-gold imports expanded in December. Merchandise exports contracted in December on weak global demand. Now, the key here to understand why the growth has remained resilient and RBI is quite comfortable on that front is because of the capacity utilization in manufacturing, which is now on a long period average at close to 74.5%, which is quite healthy. So moving towards the inflation, towards the weekly non-food credit and deposit growth. These two numbers are very important. And if you see that the credit has been growing at 18.3%, which has slightly come down to 16.7%. Similarly, the deposit growth has started to pick up, though the gap remains. But our assessment is that going forward, these two will start to converge. So the banks have increased the deposit rate, and the gap is expected to narrow going forward. Now, if you look at the inflation numbers, for the full year, RBI is projecting the inflation to be at 5.3%. Though RBI's mandate is to bring it down to 4%, but looking at the incoming data, it is expected that inflation to remain in the 5% zone for the next financial year. And if you look at the quarterly breakup, it is, first quarter is 5, second is 5.4, third is again 5.4, and fourth quarter is expected at 5.6. Another important point to note is that for the full year, the projection was 6.7% in December policy. It has been brought down by 20 basis points at 6.5%. So now, main concern of RBI was that core inflation has remained sticky, and core inflation normally comes from excess demand. So obviously, in order to keep the inflation in check and within the RBI's tolerance band, they hiked the repo rate and kept the room open to hike further if warranted. Now, the ongoing pass-through of input costs to output prices, especially in services, could continue to exert pressure on core inflation. The global commodity prices outlook is subject to uncertainties on demand prospects. China is opened up in January, so as well as from risks of supply disruptions due to geopolitical tensions. So these variations, or I would call in uncertainties, can keep the inflation slightly elevated in the near to medium term. In terms of the systemic liquidity, why RBI or the MPC kept the stance of withdrawal of accommodation is that RBI mentioned that the liquidity has remained in surplus, and during December, January, the average daily absorption under the LAP was 1.6 lakh crores. This means that liquidity has remained surplus and RBI has been absorbing that. On a YOY basis, money supply expanded by 9.8% as on January 27. India's external debt ratios are low by international standards. And in the period ahead, while the higher government expenditure and anticipated return of forex inflows are likely to augment systemic liquidity, it would get modulated by scheduled redemption of LTRO and TRO funds during February to April 2023. So going forward, we believe that liquidity is going to moderate, become neutral. Reserve Bank reiterated that it will remain flexible and responsive towards meeting the productive requirement of the economy. So overall, policy remains on the expected lines. Inflation is expected to remain around 5% for the coming financial year. Remains resilient at around 6.4 to 6.5%. The only risk that we see is that from the external sector, in terms of the Fed raising the rates further, or some geopolitical tensions coming or staying for a longer period, and putting pressure on the INR. So that could keep pressure on RBI to hike the rates if these are not favorable to us. However, looking at the present data points and the trajectory of inflation expectations, we believe that there could be a pause in the for a long period now. So rates would remain elevated in the near to medium term. Based on how the inflation and growth trajectory pans out, we could expect rate cuts happening in the maybe the end of the financial year. Till then, it could remain in a range bound range, and the 10-year GSEC, the benchmark which we see, could trade in a narrow range. So that's all about the policy today. It was on expected lines, not much surprises from the MPC, and even in the press conference, the governor and the deputy governors qualified that any action or reaction by the RBI would depend on the incoming data on inflation and growth. What is our view? What would happen going forward? A, rates are going to remain elevated for a longer period. The inflation expectations have started to soften and are expected to trend downwards. But yes, not towards the 4% mark, but closer to 5% marks. That should keep the RBI in a comfort zone. Third is that the pressure on INR is going to continue in the near to medium term because of the geopolitical situations and the further rate hike by the US Federal Reserve and the other advanced economies. Liquidity would remain comfortable even though it would be marginally positive, but RBI would keep it sufficient for the productive sector. So if you look at where one to invest today, depending upon your risk profile, all the fixed income products are very, very attractive today. Those who have a very short-term exposure or short-term horizon, liquid funds are expected to deliver a very good returns because now your repo rate is at 6.5. So the overnight rates are expected to remain in this range. So liquid funds are expected to give returns which are closer to 6.5 and plus some spread because we invest in CPs and CDs. As you move ahead of the curve, our corporate bond fund, where we normally keep a duration of 2 years, where around a 2 to 5 year paper yield between 7.5 to 760 levels, which is very attractive. And those who have a horizon of 2 to 3 years, the long bonds are very, very attractive because the yields are 10 years are at around 7.3, 7.4. And if you hold for a longer period, you get higher accrual plus mark-to-market gains when the yield starts to go down, or when actually the central banker starts to soften and cut the rates. So the entire curve is very attractive based on your risk profile and investment horizon. You can come in any one of the funds that we have. So now I'll open the floor for questions and answers.
Thank you, Pari. And there are multiple questions that have come in. So I can bucket them into three broad categories. Definitely an outlook on equities is also expected, from the participants today. So if you could, sum that up and give it, Parijat. Or would you want me to just give our outlook
Yeah,
to them?
so see, because as you know, that equity prices are depend on the interest rates in the scenario, and the how the capital cost structure is behaving.
I think there has been a technical glitch. Would request participants to just bear with us.
Yeah, sorry, I got disconnected.
Yes.
So
Please
yeah,
carry on.
so looking at today, equity markets have already reacted substantially, but with the impact of tighter rate cycle would definitely have impact on the valuations. But equity markets look resilient, and are expected to do much better on a longer term horizon. So equity markets from 2 to 5 year horizon look very promising today, because a lot of corrections, or I would say the negatives, have already been factored in. So going forward, they are definitely going to offer a very superior return.
Thank you, Pari. So, Mr. KV Krishna Kumar's question: do you expect a correction in the equity market, 5 to 10% correction in 23? And what will be the range of the market during 23 based on the global and economic situations? Extremely short term views. But
See, these short-term views we cannot predict, because markets have been extremely volatile. You just saw what happened to, with the news about one large corporate coming in and how the market reacting. So I would say that to guess anything would be very risky for the short term. Longer term, it remains very attractive. So from the 2 to 5 year horizon, equity markets are definitely very attractive.
thanks, Pari. That also answers, Mr. Roop Singh's question on 23, how the Sensex would behave. Now, a little more questions on equity which are coming up, which probably, the house views I could also share. Mr. Partha Sarathi Chandra from Kolkata has asked, which is your most attractive sector and why is the question. So, sir, as a fund house at this point in time, we are currently overweight consumer discretionary, financials, communication services, and industrials. And we are underweight on utilities and materials, and we are neutral weight on IT at this point in time. Yeah, and this is all based on the internal, fair valuation approach, and of course, what is panning out in each of these sectors. Paridar, would you want to add something to this, please?
So you have already answered. So
Right. So the next question is from, is on the Adani crisis. Of course, multiple questions from Mr. Vibhuti on Adani crisis and other volatile international issues. How should our investment perspective be? Mr. Vibhuti has asked that, and also I see Mr. Jatin Hazarika asking about, this crisis, how it will play out, in India, and yeah.
See,
If you
to
could
answer
please
your
answer
question,
that.
to answer your question, the regulators RBI and SEBI are on this job, and as per the reports that we have, the exposure of Adani debt to various banks is limited, and it would not have material impact or very significant impact on the banking sector. And in fact, most of the debt on the banking system is against cash flow generating businesses. It is not loan against shares. So from that perspective, RBI has already clarified it is very minuscule and would not have any much impact. In terms of the market reactions, markets normally react are very short sighted, so they react very fast sometimes. But if you actually see, if there is no systemic concern because of this Adani group, because the impact on currency market, the bond market, and the credit markets is not there. So had there been any very significant systemic risk, these three markets, which react very fast, would have been impacted, but we do not see that. But yes, sentiment wise, it takes a hit, but obviously these are the markets, they play out, So, and even the Adani group may look to improve their the corporate governance structure or come with more clarity. So that would come in due course of time. But as of now, I would say that markets are not too much worried on those accounts.
Thank you, Pari. In fact, the next question is coming in, on the debt side, a couple of questions from Mr. Rajiv Borpura. What is your view on MLDs? And his question is, how will it impact the yields in the current market?
Yeah, see, the MLDs were very popular with the HNIs and the companies issuing them to the HNIs because of the taxation issues. The taxation was 10%. Now that has been removed. So now the taxation would be 30% or whichever the bracket it is. So now the NBFCs which were raising on taxation issues, taxation advantages of this would find it difficult to raise. So now they will have to go back and raise NCDs, normal NCDs. So obviously the demand for MLDs are going to go down, and the NBFCs which were using this route will have to issue plain vanilla NCDs. So obviously when they will go to raise plain vanilla NCDs, obviously they'll have to offer a higher yield to the investors because generally these are lower rated corporates, maybe AA minus kind of a corporates. So obviously the spread of these papers would be higher with over the GSEC and the AAA rated PSU bonds. So obviously, these papers will go at a higher yield compared to corresponding papers. Yeah. नहीं जा रहा है यार.
Yeah, sorry. The next question, Pari, is, yes, I'm back. Sorry about that.
Yeah.
The next question is coming in from, Mr. Bashiruddin, who asks, what are the current issues that our monetary policy has in context of India, probably in India's growth or India's story itself?
The policy is flexible, inflation rate targeting. So our inflation targeting is that 4% plus minus 2, for which the RBI is committed to, and because stable or a lower inflation is very, very important for durable growth. So in terms of that, I would say that our monetary policy is well anchored.
Thank you, Parijat.
Yeah.
The next question is coming in from Mr. Riddhi Pobonbura. So he asks, what should my strategy regarding debt asset allocation in the current market be, given the low spread between G-Secs and corporate bond yields?
Yeah. So today the spread between G-Secs and triple rated corporate bonds are very, very thin. Going forward, I would say that these spreads are expected to remain in this range only, because the demand for bonds remains very high. So the strategy should be that if you are willing to stay for a longer period, corporate bond would definitely offer you higher spread. So, but you need to remain invested in that for 2 to 3 years in order to avoid any volatility, or in terms of any short term, I would say that up move which happens in the bond markets normally. So definitely, whatever the spread is, a corporate bond offers you a higher return. However, if you are looking for a good liquidity and then trade in and trade out for a shorter horizon, G-Secs offer a better option.
Thank you, Parijat. The next question is from Vedant Financial Services from Kanpur. And the question is, what returns can be expected from gilt in the next 2 years? If customers can absorb the volatility, which category of debt fund is best suited for them?
See, if you can stomach the volatility in today's market, if you remain invested for 2 years, one can get a very good return from the bond market. So I may not be able to give the exact return, or but a ballpark figure would be, see, you are getting anyway, say 7.5 kind of a accrual on the bond fund. And if I remain in a longer fund, which is where we run a duration of 5 years, and if there is any 50 basis rate cut, you can just calculate what would your return be within 2 years time. 7.5, and then 1%, 2%, or whatever the MTM gains would be there. So that's the kind of return we are looking at in a 2 year horizon. So the longer duration bonds offer the better returns today, but you will have to stomach the volatility which is there in between.
Right. Thanks, Parijat. The next question again is from Mr. Ganesh from Chennai. What percentage of correction would make it worthy to invest?
In bond markets, I would say that it is very, very difficult to guess what would be the correction. I would say keep on your investment, as and when the yields shoot up, invest at those periods. So like, yields have moved up by 5 to 7 basis points today, invest today. So again, if it moves further 5 to 7 basis points, again invest. So that should be the strategy. One cannot time the market.
Correct. Thanks, Parijat. Next question from Mr. Yash. In rising interest rates, which fund could be recommended for 3 to 6 months or 6 to 12 months?
See, as I mentioned, we are almost, where we are, the rate cycle is already, towards the end. So A money market fund definitely offers you, where we invest up to 1 year, definitely offers you a very, very good return, because 1 year CDs are at around 775 to 780%. So if you remain invested for 6 months, these funds are going to offer you a very, very handsome return.
Thank you, Parijat. Next question from Mr. Sandeep Bushetti. How do you look at dollar movements against the rupee and the interest rate hike impact on the overall Indian economy?
See, as I had mentioned in my discussion earlier, that sometimes your rate decisions are also governed by the external sector. When the US Fed is raising the rates, we have to take a cue from there, and we also have to be alert and raise the rates, otherwise it puts pressure on the NR. So from that perspective, what we have seen is that the rupee is trading around 82.5 against a dollar, which has been there. It had come down to 81.5, went back to 82.70. So now it is at back to 82.5. Now the pressure on INR has remained, and it will remain till we see that there is a pivot from the US Fed, and till then we could see some pressure there, because lot of points, or there are parts which are at play. So till that happens, there would be pressure on INR, because our CAD, current account deficit, remains under pressure because of that.
Right. Thank you, Parijat. Couple of questions coming in from Mr. Mata Prasad Pandey. I will read them out one by one. The first
Yeah,
one,
please.
as there was an announcement
Yes.
about recovery of 78,104 crores from GST compensation fund, he has two doubts in this regard. The first doubt, what was this recovery against? Second, whether such recovery can really be adjusted out of GST compensations. Thirdly, if we include the 78,000 crore along with the repayments of 3,62,000 crore, the total repayment comes to 4.4 lakh crores. Net borrowing becomes around 11 lakh 2,000 odd crores. So would it be correct to say that the net borrowing figure is 11 trillion instead of 11.80 trillion?
To answer your question, I would say that we have taken the figures which have been given by the government, and the GST compensation or adjustments. This is a very, very tricky issues, which I would say that we do not get into that. So what we do is that we take at the numbers given by the government. Yeah.
All right. The second question, moving on from Mr. Mata Prasad Pandey, RBI in its bulletin had mentioned about bringing down inflation to 4% level by 2024. But if we see the projections quarter-wise for next year, they are not supporting this fact, though the annual inflation is at 5.3%. Looks lesser compared to last year number, which was 6.5%. But the quarter-wise inflation looking northward only from 5 to 5.6. So it looks lower purely due to drawback of averages. I think he's expecting us to, you to kind of address this, whether this observation is right.
See, what we look at is that whatever RBI has mentioned, because their objective is to bring it to 4%. But looking at the incoming data of the macroeconomic data in terms of various points, RBI has projected it would be at 5.3 for the full year. So yes, there would be some impact, but 2024, what RBI had mentioned in the bulletin is that this is where they wish it to be, but it is not possible to bring it down so suddenly. So that's why they projected it to be remain at 5.3%.
Thank you, Pari. The again follow-on question on the same thing from Mr. Mata Prasad Pandey. I expect a long pause not only on domestic factors like persistent high inflation, but latest non-farm payroll data also hinted on the same and later acknowledged by Mr. Powell. Hence, fresh investors are looking to take duration call should come better with a 3-year horizon, which will not only cover the rate cut cycle, also the indexation benefit will incentivize them for the long wait. Absolutely. Would you agree with me on this or would you have a different point on this?
100% I agree with you, sir. This is an excellent time to stay invested in a duration fund and for a 3-year period. And the reasons that you mentioned are very, very true, sir. So I agree with you 100%.
Thank you, Parijat. The last question coming in from him. As we are almost done with the rate hike now, there is one major factor affecting our bond market, that is the demand supply situation of the government bonds. Do you see any mismatch there, especially due to the removal of maturity tax benefits if cumulative premium is paid by individuals is more than 5 lakhs? Recent budget news. Are they really big numbers? If yes, then are they sufficient enough to disrupt the market?
Sir, if you really see the net pouring of 11.8 is not substantially higher than compared to the last. But today, we have the GDP is going nominal by say 10.5%. So in our estimation, we believe that it can be absorbed by the existing players. And the numbers of that, what you mentioned of that insurance companies, the business coming from there, only 1 or 2 players were really large in that. The other players are not big. The percentage of their business is not big from that segment. So we believe that this would not disrupt because of that factor, but it can be easily absorbed. There's sufficient demand for the bonds. And another point is that we have RBI to take care of that.
Thank you, Parijat. Couple of questions more from Mr. Deepak Bajaj on the tax regimes. The 2 regimes of the income tax,
Yeah.
will the new regime discourage the new investors as tax savings are not necessary anymore?
If to answer it very, I would say that it wouldn't discourage, but it will tell them that see, your investment horizon has not to be because of taxation, but it needs because of investment, because you need to create wealth, not because of the taxation issues. So these are the 2 different issues, I think, where the government is trying to take the investors or the SSAs is that keep your investment decisions separate, not because of there is tax benefit on that.
Thank you, Parijat. Question from Mr. N. Jaykumar, CFA from Salem. He's asking which sectors now would be worst affected with this increase in repo rates? And I think he's also looking for an outlook on the banking sector and small cap funds on the equity side.
See, the rate hike would impact all the sectors, equally, because obviously the interest rate or, the entire yield curve moves up. So obviously your lending rates will go up, your deposit rates will also go up. So that's anyway going to impact the entire sector. But yes, it would have a different impact on depending upon how your businesses are structured. So that is going to be there. So obviously, yes, higher interest rate, higher outgo, say maybe for an housing loan EMI would definitely have some impact there. So that's the objective of RBI also, to slow down these things, slow down the demand, which are more on the consumption side. So that's where it's going to impact.
Thank you, Parijat. Last question from Mr. Faiz Ahmed. Can you tell whether the current inflation in US and India, is it a supply side inflation or a liquidity based inflation?
See, inflation always is a combination of factors. It can never be one factor. So sometimes one factor is, plays a major role. Then it comes down. Then another factor comes up. So today I would say that all the factors have together. The supply side, your liquidity which was there, substantial liquidity was there. Then substantial savings during the lockdown. Then the urge to spend. Then the labor market shortages. So all factors come together to create some, the issues. So today I would say that inflation is because of various points, and that is being tackled by the various central banks by taking out the liquidity, by hiking the interest rates, and by other measures,
All right. Thanks, Parijat.
and
That
also
brings us
by the government to ease off the supply issues.
right. Thank you. And that brings us to
Yeah.
an end of a rapid fire Q&A. I must thank all the participants on behalf of Union Mutual Fund for the wonderful questions. And I want to thank you, Pari, for taking time out for this. Friends, continue to follow us on social media, and you will definitely benefit out of your interactions with Union Mutual Fund. Thank you very much for your participation today. It means a lot to all of us. Thank you, one and all.
Thank you, and stay
Thank you,
invested.
Pari. Yes. Thanks a lot.
Yeah.
Bye-bye.
Thank you. Thank you. Bye.
Recording stopped.